A simple guide to find the next trade. We're going to identify what's working now and what historical data suggests is coming next. Really quickly, let's take a look at the economic calendar today. Consumer Price Index on a year-over-year basis was released, 2.4%. That was more or less in line with what was expected. Core CPI on a year-over-year basis, excluding the more volatile food and fuel components, 2.8%, as expected, not changing from last month. So there really was no development. Fed funds futures and the bond market hardly moved as a result. And the market more or less has been on copilot. Let's go to the market now. Let's consider the performance of the stock market since the lows of April 8th, 2025. That was the lows of that tariff crash that we saw. Now, each line represents a different sector within the S&P 500, and we'll see some sectors have performed quite well, others not so much. Here are the top performers. These are by sectors, including the ETFs: semiconductors, networking, telecom, aerospace and defense, metals and mining, technology, tech, for software. So you can see a patterns developing here. We spoke about metals and mining the other day. That's been quite strong. Gold and silver certainly are strong. There's been a buildup in aerospace and defense, but for the most part, the rally has been in technology. That certainly has led the market higher. Those Mag 7 stocks, a lot of them have been performing quite well. That's what's been working. These are the sectors that have not been working so well. Notice if you can see a pattern: home builders, real estate, utilities, energy, consumer staples. Those are all defensive positions. A lot of that obviously is centered around interest rates and real estate. There's also healthcare, but that mostly is due to the debacle of United Healthcare. That is a stock specific story. Not to say that the other stocks in that sector are doing well either, but we could exclude those as far as counting as a large sector-wide performance. For the most part, the defensive positions have not been working well. So we know what's working well, we know what's not, but how do we predict? How do we forecast what's coming next? That's not so easy. But let's take a look at the VIX, the volatility index. This measures the premium on the front month S&P 500 options. Essentially, when the stock market goes up, the VIX goes down. On the left-hand side, the VIX hit levels of 52. That was in the midst of the April tariff crash. When the stock market went down, the VIX spiked. Since then, the VIX has declined quite dramatically. We're now at levels of 17, which, relatively speaking, is a pretty low VIX. Well, what does that really mean? We measured the 30, 60, and 90-day forward performance of the S&P 500, and this is using about 10 years of data, so it's a pretty good swath of numbers. And the bars below show us the forward, again, 30, 60, and 90-day performance of the S&P 500 based on its relative position of the VIX. Currently, again, the VIX is around 17. With that said, we can expect only a few percentage points in gain over the next 30, 60, and 90 days. Conversely, if the VIX was up at the 30 or 40 level, which is certainly not that common, but when that occurs, it usually is in the midst of a stock market crash. And after a crash, we tend to see superior gains. That's not the case now. Now, it's not to say that the VIX, or the stock market will go down from here. It's complacent, but a very complacent market, it's not. A complacent market that, smells trouble, that is around 12 or 13 VIX. 17, 18 to 20, it's still conducive for an uptrend. Now, this is quite interesting here. This is the average VIX based on the number of days in the calendar year. January 1st is day 1, 2nd, etc. Today, we're about 162 days into the year. The arrow shows us, relatively speaking, the average VIX level being about 172 days, 62 days into the market. And that rests around 18, 19. So we're just a hair below the historical average. But notice what happens to those yellow bars if we move forward to the 180, 190 days within the year. It drops substantially. Now, again, remember, when the VIX goes down, it means the stock market goes up. So if history is any guide, this is telling us that the VIX, historically speaking, has more room to go down. In other words, the stock market probably has more room to go up. Here's another way to look at it. This is by month, the average VIX reading. In June, the average VIX is around 18.3. We're in the high 17s. So we're just a little bit below the historical average. But notice July. July is the lowest historical VIX over the past 10 years, and actually a lot more than that. And that tells us that July, historically speaking, is the strongest month of the year in terms of performance for the stock markets. So with that said, we may not expect, tremendous up days, but if history is any guide, again, we would likely expect the stock market to continue higher through the months of June and July. Here are the takeaways. The Fed is waiting for a change in the economy. If you've noticed, the economic data really has not been significant enough to move the Fed funds futures. We had non-farm payrolls last week, a little bit less than expected, but it didn't really, scare anybody. The markets are on autopilot. They're left to react to outside cross currents. And fortunately or unfortunately, we have quite a bit of cross currents these days, non-economic stories. And that seems to be swinging the markets around. But with that said, remember the history. Remember that June and especially July tend to be strong stock markets. So if we see, for example, one of these cross currents bring stocks down momentarily, perhaps that's a good opportunity to go long. And again, the VIX volatility index has fallen below 20. It is consistent with an uptrend. When should we be wary of this uptrend? If the VIX gets down, 12, 13, or even lower than that. Historically speaking, again, July is one of the best times for markets. So if history is any guide, again, we would expect stocks to continue stronger. Which stocks? Well, we would think the trend is your friend. And those technology, metal and mining stocks, if they've been working well so far, there's no reason to believe that will not continue for the near-term future. If, on the other hand, you want to adopt a contrarian position, maybe looking for those worst performing stocks in real estate, utilities, energy. Maybe those are great candidates for a quick reversal. Tell us what you think. What will be the next market catalyst? Do you think we continue higher from here, or is there a reversal near in our future? We hope this has been helpful. We look forward to seeing you back soon.